Hello, everyone. In this presentation, I'd like to give you the information that is helpful in creating your budgets and your cash flow plan when sitting down with your farm business management instructor. So at NCTC, FBM, and Moorhead, we emphasize the importance of having a completed FINAN with enterprising, and with that being completed, it allows us to get a good starting point by using your actual numbers from the previous year in developing your budget and your cash flow heading into the next year. If we don't happen to have that information, or you're a new farmer to the program, we'll use our area averages as a starting point in developing your budgets and cash flow. The nice thing about the FINANs being completed is here you see a screenshot. It shows last year, so in this case it's a 2019. This was the actual information from a farm, the actual data that came in from them. Here's their 3-year averages and here's their 5-year averages. So when we develop your budget, the first thing we're going to need from you are the items that are calculated on a per acre basis. So we're going to use yield. Typically, we use the 3-year average from your FINANs, which we saw previously. Price, we use FSA planning prices. This is kind of more to give a break-even sheet in the cash flow that you'll see later in a different presentation. We actually enter in sale prices in the cash flow, and you'll see that location as we move through this presentation. Any other miscellaneous income on a per acre basis, example would be maybe straw income for wheat. And then we'd want to know your seed, your fertilizer, your chemical. If you're an organic producer, your organic crop protection, your crop insurance expense, and then drying expenses. Primarily, this is seen in the corn enterprise. Other information that's helpful if you have it on a per acre basis, especially if you want to do multiple cash flows, you want to change acres to see how it impacts. It's a lot easier to have this information entered on a per acre basis than having to go back in and manually adjust some of these expenses. So things like storage, packaging, and supplies. I see this a lot with some of my seed potato producers. Custom hired labor. Our sugar beet producers, a lot of times they have specially additional labor just for the sugar beet harvest that we'd want to enter in there. Hauling and trucking expenses, and crop consultants. Typically, we're doing a 12-month cash flow from you, most likely from January to December, but we can set that up for less than 12 months. We also can create multiple year cash flows, which allow us to look at a long-range plans for the farm, as well as cash flow plans regarding loans that either are paid off in the next year or so, or if you're trying to decide on refinancing versus continuing forward with the current cash flow, it shows the implication as loans get paid off, how that helps your farm. We're also going to want to know your planned acres and planned crops by acre, along with if you do have any share rentals, what your share percentages are those. We also would need to enter that information on the budgets to make sure that share percentage gets calculated in properly. Must have that corresponding crop in the budgets, as well as we need to make sure we put labor hours in there to get them to process through and bring them into the cash flow properly. We're going to work through the next part, which is crop inventory entry. FinPac will bring in your beginning inventory amounts off of your balance sheet, and then you've got to work kind of with your instructor to develop or enter when that inventory is going to be sold, both on the old crop and new crop, and then the value that it's sold at. Prices and amounts are entered in the planned months, and if prices are unknown on new crop sales, we typically use FSA planning prices unless you have some sort of premium or different price that you have locked in. If it's planned to be carried over to the end of the year, there's a little ending inventory amount that we would enter in there. Again, most likely we would use those FSA planning prices. Then we're going to deal with the direct crop and livestock expenses. These are all calculated automatically by the budgets and the acres being entered in, and automatically are brought into, and they're actually distributed to appropriate months based on a FinPac allocation. We can adjust those things in FinPac, but the dollar amounts come in automatically. The relating operating expenses will need to be entered in directly. History gives us ideas. Again, we see the last year, the 3-year, and the 5-year averages to use for expenses. Otherwise, we'll work together to get corrected amounts, especially if we're adjusting acres up or down significantly from the previous years. And we want to make sure we get those expenses into the appropriate or correct months. Again, they're allocated automatically. but we want to make sure they're put in, especially if there's certain expenses that all happen in the spring or only in the fall, because it does give us an idea of what your borrowing needs are for the bank based on when expenses are expected to happen. So these are items that are above what's entered in the budget. So again, would be storage, fuel and oil, repairs, custom hire, hired labor, owner wages and benefits. So if you're a corporation or maybe an LLC where the farm just pays a set wage to you as an owner, you'd want to enter in that information there. Land rent, and then stock quota lease for our sugar beet producers. That's the joint venture for their beets. Then we'd have several leases, machinery, building, livestock, real estate taxes, farm insurance, utilities, consultants, marketing, dues and professional fees, organic certification if you're an organic producer, and other miscellaneous overhead expenses. Accounts payable needs to be brought in from the balance sheet. It does not automatically transfer in, so we need to make sure any accounts payable you had as of the beginning of that balance sheet being brought in and then distributed and when those expenses are needed to be paid, most likely in the first month or so of the cash flow. Other cash flow information needed, if there's any CCC market loan gain, typically not. Recently, we haven't seen those. Direct and CC government payments, CRP payments usually are kind of known from year to year. They're very consistent. Conservation government payments, things like EQIP or CSP that are continuing for several years, you can enter that information in. Other government payments this year in 2021, we're actually going to be bringing in the CFAP-3 program payments into the government payments because we know that. Your Arc County PLC payments that we're seeing typically aren't known until middle of the summer, so we usually don't use a number in that. Custom work income, contract livestock income, renewable energy, farm rental income, patronage dividends, cash. So this would be the cash dividends received. Again, we like to use those average numbers. And then if we know this is where the unit retains for our sugar beet producers gets entered in. And then any other crop insurance income, especially if you have crop insurance that's being deferred from or brought in from 2020, in this case, into 2021. So other farm income things, personal wages, personal business or rental or interest income, personal dividends, any tax refunds that are expected, other personal income, gifts, inheritances, cash gifts that are expected to be given, family living or your owner draw for the year, and your income and Social Security taxes. One of the things that we like to emphasize is when we do the family living and the owner draw, one of the things that's included when you compare this number from previous years, we like to use a very similar number, but in some cases, your principal and interest on your personal loans is entered on the loan payment schedule in the cash flow plan, but on your FINAN, the principal is allocated one spot, the interest is all put as a family living expense. So if that's a pretty large number, that can make a difference between what your actual family living is and what we can adjust it to. We want to make sure we also match our income and Social Security taxes when they're paid based on what we have as a beginning inventory or beginning payable on the balance sheet. Otherwise, it kind of throws off some of the information on the printout just because we don't have matching beginning numbers. Then if you have any planned purchases or sales during the year, so what's going to be planned to be sold or purchased, what type of category is it, and the amounts along with the expected month that that's supposed to happen. Then any new borrowings, so the amount borrowed, the month of borrowing, this is where if we did any refinancing or if we're going to finance any equipment purchases or land purchases, we'd enter in the actual dollar amount and the month that's expected to happen. And then when we get to the loan payments, you'll notice these two new loans, the amount borrowed, we've got, and you can see this in older cash flow, we have higher interest rates, but we got to make sure we have the interest rate added in or adjusted in here if we have changes to that. And the expected principal and interest payment. For some of these, we can calculate that automatically. For those that are already on the balance sheet, they come in automatically. If we're using new loans to pay off old loans, we need to make sure we show that payoff in the correct month and pay off all the principal and all the interest from that. If there happens to be any additional money above that, then that just gets rolled into the general payoff of operating or into working capital for the farm. Your annual operating loan page, we have to make sure we have a minimum cash balance in there. For each month, we have to make sure we have the correct interest loan rate for your operating and when interest payments are typically made. A lot of times we make a payment in the month of renewal of that, and then sometimes usually at the end of the year because some farmers will pay off their interest at the year end. And all this helps us calculating the operating borrowing needs for the farm. And then at the end, there's a balance sheet entry. Some of this information from the beginning balance sheet, we want to make sure is either entered into the cash flow for you or we carry it into the next year. And that's something that you work with your instructor to make entries on your ending balance sheet. That's the information that's needed for your cash flow and your budgets. And the next presentation that we're going to provide will be understanding your cash flow statement.